Just got done editing this interview. You guys are going to love it. Before I do that, though, I want you to know that I'm going to be in the comments for the next 30 minutes or so answering your questions. If there's additional questions you want me to ask the CEO next time I interview them, leave them below. Or if you're just loving the data points I get CEOs to share, click the thumbs up button below. That's your way of telling me you're loving this stuff, and I'll get you more of it. Additionally, again, I'll be in the comments answering any questions you have. All right, for 30 minutes. Enjoy the interview. Hello, everyone. My guest today is Steve Benson. He's the founder and CEO of Badger Maps. After receiving his MBA from Stanford, he was Google's enterprise top sales executive in 2009. You can tell because he has perfected that wave. In 2012, Steve founded Badger Maps, a software company that helps field salespeople optimize their routes and schedules to save time and be on time so they can sell more. Steve, you ready to take us to the top?
Let's do it.
All right. I'm not going to beat around the bush or anything here, right? So last time you came on the show, you shared, you broke about $3 million in ARR. You were serving 7,500 customers. I believe those are actual salespeople inside of companies. So those are that's your user base, but it's to help them do field sales. No one's driving around doing field sales right now. As a software CEO, how are you responding to the virus?
Well, so I think that we're one of those companies that will be affected by this because of the service that we provide, helping field salespeople go and meet their customers. So dentists, for example, right now aren't, they're probably not buying a lot of new fake teeth or new tools or new medical devices. And so our customers, the people that go and sell that dentist, that type of stuff, they're not getting meetings. They're not out in the field. Some software companies will be impacted differently than others. I mean, obviously, if you were Zoom, then more people need your stuff right now. But for us, definitely, there's going to be going to be a downtrend in demand for our products, at least for the short term here.
Mm-hmm. And so many CEOs right now are thinking about things like how much cash do I have in the bank relative to my runway if I get no new revenue. Should I plan for 3 months? Is it going to be a quick turnaround, or should I plan for like 7 or 8 months? Is it going to be a little bit longer than everyone expects? What are your thoughts?
Mm-hmm. Well, I think that the more cash you have on hand right now, the better off you are, and just hunker down and make the product great for when you come out on the other side, and kind of turn the focus to that. On the sales and customer success side, I would say people, at least what I'm thinking about is how do I make the customers that I have more successful? How do I keep them extremely happy? And how do I find new customers who maybe are in a slightly different area than I was working with before the crisis started? So can I pivot to a slightly different customer set that is going to have great needs going forward for this, or even short-term needs while this is happening. So an example there for us is doctors, nurses, other services that go to people's homes, helping them organize what they're doing on a map. So they're not, historically we help salespeople do this, but we've run into companies like this before where a hospital group is doing a bunch of home visits, and so they'll have their doctors or their nurses organized using our tool. So that's where we're going to be looking to pivot towards things like that and bring in new business from that instead of to make up for the lost business in other places.
So when you did come on last, that was October 29th of 2018, pre-virus, so 3-4 weeks ago. What did you grow your customer base to?
Well, and not a lot has changed for us. I think we've lost about $1,000 in MRR so far. But we're at about 355 right now in MRR.
Mm-hmm.
So,
and how many customers
whatever
is
that is? Probably 8,000, 9,000.
Okay. 8,000.
I don't tend to count the absolute numbers. We're in an interesting position because we have kind of like a B2C business and a B2C business, B2B and B2C, which is a little weird because an individual can use us for their job. And so they behave very much like B2C customers, but then a lot of our customers it's a large company or a team that is using us for their entire sales team. And so they behave obviously much more like a B2B customer.
Yep.
So The absolute, MRR is much more important than the absolute number of customers.
Well, yeah, still good growth, right? About a year and 3 months ago, again, you had about 250,000 in MRR. You've added 100 grand in new MRR since then, or 1.2 million in ARR. If you're up to 9,000 seats now, that's 9,000 seats. Field sales reps paying $40 ish each per month, so it's nice growth. As you're thinking about, so I mean, one of the things, if I was in your shoes, that I would be making plans for is, will I see a massive cancellation spike or a massive hey, Steve, emails to you, can we pause our account for 3 months? We love you, but can we pause for 3 months while we figure out what we're doing?
Yep.
How are you getting those? And if so, how do you handle that?
So I'm expecting those. I haven't gotten many yet. I mean, it's still early, right? I mean, I don't know when this will publish, but it's March 17th right now.
Yeah.
So San Francisco was just locked down, and people aren't supposed to go to restaurants or bars as of yesterday. So that's kind of where we're at right now. So I haven't seen a ton of that yet. I think so. I just had a conversation with my VP of sales about this morning. Actually, is how do we respond to those calls of people quitting? And we haven't had many, but I think that what we landed on was, when an individual calls, we should offer them half off for 3 months if they call to quit. Offer them half off for 3 months, and see if they do that instead of quitting. And I think the reasoning there is, then their stuff's not all deleted; it's still in the system. It's they don't have to reset anything up. We don't have to reset them up, which is good for us. So it's kind of a win-win for everybody. For larger companies, I think I don't think what we would, for the B2B side of the business, which is bigger than the B2C. I don't think we would do that, because company, just like we have to batten down the hatches, that other businesses need to too. So, I think we're going to
Steve, that's the key question, right? That's the key question, is when everyone has this internal dialogue of what their version of batten down the hatches means. You hope that, and whoever's listening, you hope that your piece of software is one of the things that makes that makes the cut, that is critical, that they can't do without. Exactly. Right. And that's the question, is what's critical and what's not.
Yeah. Well, I mean, and I don't know how deep people are going to have to cut, right? I think when businesses get in situations like this, they make a series of cuts. They trim off a little flesh, and then they go a little deeper, and they go a little deeper, and eventually they hit bone. But it'll likely be a fairly painful process for a lot of businesses in the world. I mean, some are already in deep trouble immediately. Obviously, if you're a bars are. If you're a bar in San Francisco, the bars are closed. So your revenue just dropped to zero.
Let's give more people more color on how you've built the business to date, so they can figure out kind of, hey, am I in Steve's shoes as well? So you're a bit unique here in that you've done, I think, a great job scaling a company, basically bootstrapped, right? So to date, how much equity have you raised?
I think we did about 8% convertible note, and this is 7 years ago, we did this. So, but no other equity other than that. So we've sold 8% of the business in convertible notes, but no professional money in. No.
And that was for $800,000, something like that.
I think more like 450, if I recall.
Okay, 450. And you've also since then used debt to scale. Again, I would argue fairly effectively. Walk me through that process. This debt product over the past 2 years has become more and more popular. There's more firms offering it for software CEOs specifically that have raised debt, especially if it's not debt that is paid back 4 to 8% of your gross monthly receipts, right? So debt that is fixed, that even if you have to give your customers half off and your revenue drops, you still owe a fixed amount. How are you thinking about that? And how do you recommend other founders with the same structure should think about it?
I think it's a great time to take on debt, because this doesn't last forever, right? This is likely a shorter term bump. Is it a 3-month problem? Is it an 8-month problem? I'm not sure, but it's certainly not a 2-week problem, and it's certainly not a 2-year problem. So I think there are a lot of fantastic debt providers out there that have really gone after the SaaS space. And I think that there are 40 of them, and some of them are better than others, but I haven't run into many terrible ones. I've run into and I haven't run into any amazing deals or anything. It's relatively expensive capital, but I think it's a great time for people to look to bring debt into the business. And kind of get through this period of time.
Mm-hmm. Yeah. I mean, so, I am, and full disclosure for you guys listening, I've put some debt money into Stephen Badger, along with another firm. But like one of the things that I'm recommending for anyone coming to me right now for feedback is debt is a great option. If you can't raise VC right now, because debt is great, but you should try your hardest to negotiate that debt where there is no prepayment penalty and max prepayment penalty, maybe interest for a year, because all you're trying to do is get enough cash in the bank to outlast your, it's not 2 weeks, it's not 2 years, just to outlast this, disaster. And then what you can do is a couple things. You can just prepay it all, right? Once everything's safe again. Or if you then go raise equity, you can pay off, the debt with the equity once the VC markets open up again. So this is something I'm definitely telling all the founders I speak with to look at.
I think it's a really good, if you haven't tapped debt before, I would ask you why you haven't tapped debt before, but
well, you're unique though, Steve. A lot of people haven't, they're not, especially being in California, right? Some people don't know it exists, and others just don't understand how it works. What would you say are some of the gotchas people need to watch out for if they do raise debt in this time frame specifically?
Oh, I've got a whole doc on this.
I'm teeing you up softballs here.
Yeah, I don't know if I'll be able to find it that quickly.
Just give like the top 2 or 3, and we'll link to the doc in the show notes.
Okay. So things to watch out for. Offers that, well, first of all, it is relatively expensive money, but some are extremely expensive money. So, there are lenders, business lenders. Businesses aren't protected like consumers are protected from lenders. So there's not like
usury laws.
You can't. Usury laws, meaning there are rules around how much you can charge a consumer for in interest. There are no such rules around for businesses. So half the lenders out there just charge egregious rates.
What's egregious?
40%. I'd say anything over 22% is egregious, and 22% sounds high. But if you're making $500,000 a year as a SaaS company, they're taking a fair amount of risk. And if you're growing fast and you feel confident in the business, 22% is not that much money, because if you sold equity, that's that could be 100 or 200% return for the investors, or even more, right? So. But as you get larger, I think the prices come down to more around 16, 17, 18%. And that's I think that's much more reasonable for a more mid-sized SaaS company. If you're over $3 million, I think you start creeping into that area. Gotchas include, other than the price, obviously, the lender being able to call a loan back at their discretion. So them being able to say, oh, that $500,000 you borrowed, we need that. We need that back. We need it back now. And that's obviously a problem, because you probably took that money so that you could spend it and invest it, and you probably don't have it laying around. So them being able to call the loan back is a problem. Liquidity covenants. You see this a lot with banks. Like they'll tell you, hey, we want you to have, you're borrowing $1 million from us, and we want you to always have at least $500,000 in the bank with us at all times. Well, so then you actually only just borrowed $500,000, because the other $500,000 you can't touch. It's just a pretty number on a piece of paper that you can never do anything with. So that's a silly thing that some lenders will do. You'll see lenders say, "Oh, here's $1 million, but you have to have $1 million in the bank," and you're like, "Well, that's crazy. Well, what's the point?" So covenant, the whole covenant section is all negotiable and all to be looked at with a fine tooth comb. So like speeding up your payback if something changes, or changing the interest rate if something changes, like if your revenue slows or contracts, or any term they want, really. If you lose a key employee, they can put whatever they want in a covenant section. So watch for tricky things like that, where they change the terms, or the loan fundamentally changes if something happens. If your EBITDA goes down, for example, you'll see that one a lot. Like, if your EBITDA drops, meaning your profitability drops, then your interest rate goes up. Early payback penalties, you mentioned, that's one you see a lot, where even a lot of the good lenders will say, oh, well, but if you want to pay it back early, then you owe us this penalty. And that's negotiable. I mean, because you should be able to, if you're paying someone 22% and someone else offered you 17%, you should be able to just take the loan for 17%, pay back the loan for 22%, and now you're in a better place. But if they put a big penalty in there, and you'll see some companies put a penalty around, like, oh, well, you have to pay you have to pay the interest that you would have paid if you had kept the loan the entire time, as a penalty if you pay back early. They'll block you from getting other loans. That's a common one. Yep. So that you'll see, like, okay, well, great. Like, and it's like,
they right of first refusal or something like that. Yeah, that nature. These are
full block
or full block. Yeah. These are all because they want you to keep their money, because they keep making that high interest rate, right? They don't want you to be able to go, get leverage and compete against them and get cheaper money. So yeah, guys, those are all great things to look out for. Steve, dude, I appreciate you making time to jump on and kind of talk through how you're thinking about this as a SaaS CEO, how debt is good or bad in this scenario. And congratulations, 7,500 to 9,000 customers, extra $100,000 in MRR over the past 12 months, man. I'm rooting for you. Let's wrap up with the famous 5. Number 1, favorite business book.
Famous. I mean, it's trite to say this, but Impossible to Inevitable was, and all the articles that made it up were critical for me.
Number 2,
growing this company.
Is there a CEO you're following or studying?
A CEO I'm following or studying right now? Not really.
Okay. There's not many homework on your famous not many 5. To follow right now. Unprecedented times. Number 3, favorite online tool for building the company.
AWS. I mean, that's been key.
Number 4, how many hours of sleep do you get every night?
Well, the first time I came on your show, which I think was probably 2014, or something like that. A long time ago, yeah. The answer there then was probably like 4.5, 5, but now it's probably 7 to 7.5.
That's good.
Like that's been a big change that's happened in the last few years, is now that I'm actually able to get a little sleep.
And married, single, kids, what's the situation?
I've got a fiance.
Oh, good. Any kids running around?
No kids.
No kids. Yet. All right. And how old are you?
I am 42.
42. Last question. What do you wish your 20-year-old self knew?
I guess if I could give advice to my 20-year-old self, it would be to not work at big companies sooner. So I learned a ton working at big companies, but I could have trimmed that by about a decade and started working for small companies much quicker, or just always work for small companies. Like, I've watched people that work for me at Badger just develop so much faster than I was able to, because they're able to have so much more responsibility. Like a person on a marketing team at a 10-person company is the only person on the marketing team, and they're in charge and have real responsibilities of important things. Whereas if you're on the marketing team at Facebook, you own such a tiny slice of such a big thing that it's hard. You don't get the same learnings, I don't think. So I guess I would tell myself to work at big companies for a very short period of time, or to always work at small companies.
Guys, there you have it. Badger Maps. They've added about $100,000 in MRR over the past, call it, year and a half, doing $350,000 per month in revenue. But they sell to field sales reps, and reps are not selling right now because of the virus. And we're worrying about cash in the bank and burn. And Steve has done a good job raising some debt capital to make sure that he's able to kind of get through this time. Also planning for when customers email in and ask for things like, pause the account or even cancel the account, and what does response times look like. So far over the past, call it, week, 2-3 weeks, only about $1,000 in MRR lost out of his $350,000 a month base. So still healthy, still good. We'll stay up in touch. Steve, we're rooting for you, man. Thanks for taking us to the top.
Thanks, Nate. It's great to chat again.
These CEOs rarely give these kinds of interviews. I hit them hard, I get the data, and I want to do it more. So if you want to get more of this stuff, make sure you subscribe up here. And then additionally, go check out one of my other CEO interviews right now.